If you pick the wrong state to retire in 2026, you may not run out of money first, but later you realize something was wrong. People imagine retirement as sunshine, lower taxes, maybe a cheaper house and a slower life. They rarely imagine a state quietly running out of room to maneuver and looking around for someone to send the bill to. Very often, that someone is the person who can't easily move anymore. When I look at a map of America, I don't just see beaches and mountains. I see balance sheets, unfunded pensions, strained hospitals, insurance markets that are starting to walk away. Some of the most popular retirement states sit right on those fault lines. On the surface, they look like a dream. Beneath the arithmetic is getting worse, not better. In this conversation, I want to do one simple thing, show you the 7 states I would not choose to retire in 2026 and why. When most people think about retirement, they picture a place, not a balance sheet. They see a porch, a beach, a golf course, a city with good restaurants. They don't see the numbers underneath that view. Over the years, I've watched a lot of people move for lifestyle and only later discover they had, in effect, bought stock in a very shaky company, their new state. When I look at a state, I look at it the same way. I'd look at a business. I might buy outright. It has revenues and expenses. It has long-term promises and short-term pressures. It has management that either faces reality early or delays it as long as possible. And if you're going to retire there, you are tying your future to that one business in a way that is very hard to unwind once you've sold the house, moved the furniture, and built a life. The couple who moves purely for sunshine or a lower tax bill often thinks the biggest risk is their portfolio. I don't see it that way. Your portfolio you can diversify, rebalance, move in and out of. Your state is harder to change. I've seen 2 families with similar savings end up in very different worlds simply because one of them chose a state that was honest with its numbers and the other chose a state that treated math as a suggestion. What gets people in trouble is what they don't look at. They don't ask simple questions. Is this state spending more than it takes in year after year? Has it promised pensions and benefits it hasn't funded? Does it depend on 1 or 2 volatile sources of revenue that can vanish in a downturn? All of those things matter because when the gap between promises and reality gets too big, somebody has to close it. And retirees with fixed incomes and immobile houses are very tempting targets. I pay a lot of attention to taxes, but probably not in the way most people do. A low headline tax rate today doesn't impress me much if I can see the hole in the budget down the road. If a state has been postponing repairs, underfunding pensions, and borrowing heavily, I don't ask, how low are taxes now? I ask, how high will they have to go later? Because later is usually when you're living there on a fixed income, when it's hardest for you to adjust. Then there's the basic cost of services you're going to rely on: healthcare, utilities, public safety, local infrastructure. A state that has put those systems off to the side while it chases growth or hands out temporary goodies can look attractive to a newcomer. The roads are still drivable, the hospitals are still open, the crime isn't out of control. But if the state's finances are stretched and the population is aging, you can almost feel the pressure building. At some point, something has to give: higher taxes, reduced services, or both. Insurance is another piece people ignore until it's too late. In parts of the country, I've watched insurers quietly raise premiums, tighten coverage, or walk away altogether as the cost of storms, fires, or floods mounts. If you're retired and your home insurance doubles or triples, or you suddenly find your coverage canceled and have to scramble for an expensive replacement, that's not a theoretical problem. That's cash leaving your pocket every single year. And it's not an accident. It's the insurance market's way of telling you the risk in that area is higher than it used to be. All of these things, debt, unfunded promises, demographic trends, climate exposure, insurance behavior, come together into one question for me. If I put myself in this state for the next 20 or 30 years, who is depending on me to quietly pay for their past decisions? If the honest answer is a lot of people, I start to back away, no matter how pleasant the weather might be or how low the income tax looks right now. I don't say any of this to frighten you out of moving or to tell you there is some perfect risk-free place to grow old. There isn't. Every state, like every business, has trade-offs. What I am saying is that treating retirement as a postcard decision instead of an investment decision is a mistake you don't get many chances to correct. Once you've chosen, inertia sets in. Moving again in your 70s or 80s is a lot harder than moving in your 50s. So before you fall in love with a view, I'd urge you to look at the numbers. Ask whether this state is living within its means. Ask whether it has been honest about its obligations. Ask whether young people and businesses are moving in or quietly leaving. Because in my experience, when the tide goes out on a fragile state, the people who feel it first and deepest are the ones who can't easily get up and leave. And that's the group you'll be joining in retirement. When I look at a place to live, I don't start with the palm trees or the brochure. I start with a balance sheet and the map. A state, to me, looks a lot like a business. It has income, it has expenses, it has long-term obligations, and it has managers making choices about whether to face reality early or push it off onto the next group of people. If you're going to retire there, you're effectively buying a very large, very illiquid stake in that business, and you're agreeing to hold it for decades. So I ask myself a simple question. If this state were a company, would I be comfortable owning a big chunk of it for the rest of my life? If the answer is no, then it doesn't matter how pretty the sunsets are. Enough pretty sunsets won't fix a broken income statement. In the short term, you can disguise a lot of problems. In the long term, arithmetic always wins. The first thing I look at is fiscal health. Is this state spending more than it brings in year after year? Has it been plugging holes with one-time tricks, borrowing, asset sales, or federal windfalls that won't always be there? A business that operates that way eventually runs out of room. A state isn't any different. When that happens, they don't liquidate the company. They liquidate your expectations. They raise taxes, they tack on fees, they cut services, and they hope you accept it because moving is hard. Then I look at the promises they've made. Pensions, retiree, health care, various benefit programs. Have they actually funded those, or have they written generous IOUs that someone down the line will have to make good on? If the gap between what's been promised and what's been funded is very wide, I assume that gap will be closed by future taxpayers and future residents. If you're a retiree, that's you. You're not just moving to warmer weather. You're volunteering to be part of the cleanup crew. Demographics matter to me just as much as the balance sheet. A state that's aging rapidly and losing working age residents is in a tougher spot than one that's attracting young families and businesses. If the tax base is shrinking while obligations are growing, the math gets worse every year. An older population needs more health care, more services, more support. If there aren't enough new workers and new companies coming in to pay for that, the pressure builds. Eventually it shows up in ways retirees can't ignore. Higher property taxes, new surcharges, fewer services, more strain on hospitals and clinics. I also pay attention to economic concentration. Some states lean heavily on one or two industries: tourism, energy, tech, finance. When times are good, that can look wonderful. Revenues surge, politicians feel generous, and nobody worries much about the next downturn. But I've lived long enough to know that every industry has cycles. When a concentrated state hits a bad patch, the revenue drop can be sudden and sharp. If they've been spending as if the good times will last forever, that's when the real trouble starts. On top of all that, there's the physical world. Over the last couple of decades, it's become very clear that some regions are going to face more frequent and more expensive natural disasters, hurricanes, wildfires, floods. You see it not just in the headlines, but in the behavior of insurers and reinsurers. When I see an insurance market starting to pull back from a region, raise premiums dramatically, or tighten conditions, that's a signal. It tells me the risk has gone up in a way that's hard to reverse. For a retiree on a fixed income, an insurance shock can feel like a tax increase you never voted for. Governance is the last piece, and it might be the most important. Some states have a track record of facing bad news early, making unpopular decisions, and cleaning up their books. Others have a habit of pushing problems into the future, using rosy projections, and telling people what they want to hear. I don't need perfection, but I do want honesty. If the leadership has spent years pretending that obvious problems will somehow solve themselves, I assume they'll keep doing that until circumstances force their hand. You don't want to be there the year reality finally arrives. When you put all of this together, a picture starts to form. A state with modest debt, funded promises, a healthy mix of industries, growing population, manageable physical risks, and a history of straightforward budgeting is not risk-free. Nothing is. But it gives you a margin of safety. A state with high debt, large unfunded obligations, aging demographics, concentrated industries, rising disaster costs, and a habit of gimmicks instead of solutions is something else entirely. The danger is that from the outside, those two states can look surprisingly similar. Both may have nice weather. Both may advertise low taxes. Both may show you glossy marketing about quality of life. The difference is in the foundation. One has been pouring concrete for years. The other has been painting over cracks. As an investor, I've learned it's much better to live on the concrete than on the paint. So when I talk about not retiring in certain places, I'm not making a cultural judgment. I'm making a balance sheet judgment. I'm looking at the combination of fiscal health, promises, demographics, economic base, physical risk, and governance. And I'm asking a simple question. If things get tougher over the next decade, and at some point they will, who is going to be asked to carry the load? If the honest answer seems to be people who own homes and live on savings, I put that state in the danger column. And that's where some very popular retirement destinations are today. When interest rates rise and inflation lingers, almost everyone looks at their portfolio and almost no one looks at their state. Yet the very same forces that stress companies and households also stress governments. When money is no longer cheap and growth slows, the weak players start to show. I've watched that happen again and again over the decades. It's not different just because the weak player this time has a flag instead of a ticker symbol. Higher interest rates don't just change the value of bonds and stocks, they change the cost of every dollar a state has borrowed. For years, a lot of states got used to financing projects and plugging gaps with very low-cost debt. That feels painless while it lasts. When those bonds mature and have to be rolled over at higher rates, the interest bill grows. If revenues aren't growing as fast, that new interest cost has to come from somewhere, higher taxes, lower services, or both. As an investor, I always ask, who ultimately pays? In a state under stress, the answer is usually the people who can't easily leave. Inflation in services makes this even more challenging. Retirees feel it most acutely in healthcare, housing-related costs, and everyday services. States feel it in payrolls, in healthcare programs, in contracts to maintain infrastructure. If the cost of everything they buy and everyone they employ goes up faster than their tax base, even a small imbalance becomes a widening gap. In good times, growth can paper over that. In a slower, more expensive world, you start to see which states had real discipline and which ones were just riding the tide. Demographics add another layer. A state with a young, growing workforce and healthy in-migration has options. A state that is aging rapidly, losing working-age residents, and leaning heavily on a smaller tax base has far fewer. If you are retired in a place where more people are drawing on services and fewer are paying in, you don't need a degree in economics to see where that story ends. Someone will be asked to pay more for less. That's not a moral judgment. That's just how balance sheets work. Then there is the physical reality of where you live. Over time, I've watched the cost of hurricanes, wildfires, and floods rise, not just in dollars, but in the way markets respond. Insurers are not sentimental. When the expected cost of losses in a region climbs, they react. Premiums rise. Deductibles grow. Coverage shrinks. In some cases, they simply pull back. When that happens, the risk doesn't disappear. It moves to homeowners, small businesses, and ultimately taxpayers. If you own a home in that environment, in retirement, you're suddenly in a business you didn't sign up for, self-insuring part of your biggest asset. All of this shows up in places you can see if you know where to look. You see it in widening budget gaps. You see it in credit downgrades. You see it in news about insurers pulling out of coastal markets. in rising special assessments for infrastructure, in steady out migration from high-stress, high-cost regions. You don't need precise numbers to understand the direction of travel. If a state has been running close to the edge and the world becomes more expensive, more volatile, and less forgiving, that edge gets thinner. For retirees, the critical point is simple. You are tying a large portion of your future to how one state handles this new environment. If that state has strong finances, diversified industries, manageable physical risks, and a habit of dealing with problems early, you may not notice much beyond normal ups and downs. If it has weak finances, concentrated industries, growing physical risks, and a habit of delay, you will notice. You'll see it in higher taxes, higher insurance, more crowded and strained public systems, and a general feeling that you are being asked to quietly subsidize past decisions. I don't think you need to be terrified by that, but you do need to be realistic. We are moving into a period where the gap between strong and weak states is likely to widen, not narrow. The same macro forces that reward prudence and punish excess in markets will do the same on the map. If you ignore that because the palm trees look nice or the sales tax is low this year, you're making a bet, not just on markets, but on politics, weather, and human nature. From an investor's point of view, it makes more sense to assume that pressure will increase, not decrease, on fragile systems. That doesn't mean every risky state will collapse or that every safe-looking state will stay perfect. It does mean you want to be very careful about planning yourself where higher rates, sticky inflation, demographic strain, and climate risk all intersect. Because in that intersection, when the bills come due, retirees standing still are the easiest pockets to reach. I've learned over the years that the most dangerous deals are the ones that look the most attractive at first glance. The proposition that seems too good to question often turns out to be the one that needed the most questions. States are no different. Some of the places marketed most aggressively as retirement havens sit right on top of structural problems that are only going to get worse. I think of these as retirement traps, not because anyone designed them that way, but because the underlying math has been ignored for so long that when it finally catches up, the people least able to adapt will be hurt the most. A retiree who has sold a house, moved savings, and built a life in a new place is not in a strong position to quickly reverse course. The state knows that. So does the tax collector. There are a few patterns I see repeated. They'll call the first one the Sun Belt Mirage. These are states that grew very rapidly, attracted by warm weather and the promise of low taxes. Growth felt like prosperity, and for a while it was, but a lot of that growth was built on cheap credit, underpriced insurance, and infrastructure that was never quite funded to the level it needed to be. When disaster costs rise, when insurance markets retreat, when the bills for roads and water systems and emergency services finally come due, the mirage starts to shimmer and fade. What looked like a bargain turns out to have been a bet that the weather would stay mild and the federal government would always be there to rebuild. Another pattern is the overpromiser. These states offer generous services and benefits without charging anywhere near enough in taxes to sustain them. For years, they made up the difference with borrowing, with creative accounting, with one-time revenue sources that weren't going to repeat. Politicians in those places got very good at explaining why this year's deficit was temporary and next year everything would balance. It never did. The gap kept growing. At some point, someone has to pay the bill. If you're a retiree with a house and visible income, you are an easy target. Then there's the shrinking base. These are states that used to have a strong industrial or resource economy and a young, stable workforce. Over time, that economy shifted, the factories closed or moved, the young people left, and what remained was an aging population with fewer and fewer workers to support it. The tax base shrank while the demands on healthcare, pensions, and services grew. Politicians kept promising they could manage it, but the arithmetic doesn't cooperate. When you see out-migration accelerating and the population aging rapidly, you are watching a slow-motion budget crisis. Retirees who move there hoping for a low cost of living may find that cost rising fast as the state tries to squeeze revenue from a shrinking pool. Finally, there's the disaster zone. These are places where repeated hurricanes, wildfires, floods, or other major events have made it clear that the physical risk is no longer an occasional bad year, but a recurring feature of life. Insurance companies, which are unsentimental about risk, have started raising premiums sharply or pulling out altogether. Rebuilding gets more expensive each time. Federal disaster aid is generous, but it doesn't cover everything, and there's no guarantee it always will. If you own a home in one of these places and you're on a fixed income, every storm season is a financial stress test. At some point, you have to ask whether the beach view is worth the risk of losing a large part of your net worth in a single event. All four of these patterns share something in common. They take a problem that's been building for years and push it onto the next group of people who can't easily say no. In a strong economy with falling interest rates and rising asset prices, you can get away with that for a surprisingly long time. In a world where rates are higher, growth is slower, and natural disasters are more expensive, the bill arrives faster. For a retiree, the key question is simple. When you look at a state through this lens, are you seeing a place that has been honest about its limitations and careful with its promises, or are you seeing a place that has been betting everything will work out and that someone else will cover the gap if it doesn't? If it's the latter, you need to understand that the someone else they're counting on may very well be you. Let me start with a few places that would worry me the most if I were living on a fixed income and planning to stay put for the next 20 or 30 years. I'm not talking about culture or scenery or politics. I'm talking about fragility. If I can see that a state is walking into the next decade with weak finances, rising physical risk, and a habit of delaying hard choices, that's enough for me to put it on my do not retire here list. The first group is what I think of as the classic Sunbelt story, gone too far. These are states that sold themselves very successfully on warmth, low taxes, and endless growth. For a while, that growth did a lot of heavy lifting. New arrivals meant new construction, new sales tax, new development fees. It felt like prosperity. But underneath, the bills for roads, water systems, schools, hospitals, and emergency services kept piling up. At the same time, hurricanes, floods, or wildfires grew more frequent and more expensive. Insurance companies started to raise premiums sharply or leave certain zip codes altogether. If I see a state where property insurance is becoming hard to get or painfully expensive, where every storm season feels like a spin of the roulette wheel, I don't want to be the retiree holding a large immobile asset there. Then there are states that have been famous for budget stress for a long time. Everyone knows they have deep pension holes, heavy debts, and a long history of promising more than they were willing to pay for. When the economy is booming, they can limp along. Markets are generous, revenues come in higher than expected, and the can gets a good solid kick down the road. But retirement is not a short-term trade. If I'm planning to live off my savings for 20 or 30 years, I have to assume there will be at least one serious downturn in that window. In that kind of environment, the states that already started from a position of weakness are the ones that will reach for every lever they can find. Higher property taxes, new temporary surcharges, creative fees on everything that doesn't move, and cuts to services that retirees quietly depend on. Another kind of state that goes on my danger list is one where the population story is clearly running backward. I pay close attention to places that are losing working age people year after year while the elderly share of the population keeps rising. That's a very simple equation. More people drawing on services, fewer paying in. You don't need complicated models for that. But if factories have closed, if young families are moving away for better jobs, if the tax base is shrinking and the average age is climbing, you're looking at a system under increasing strain. In that kind of environment, a retiree moving in because housing is cheap may be stepping into a trap. Cheap today can turn into costly tomorrow when the town council is staring at a budget shortfall and a long list of non-negotiable bills. I also stay away from places that depend heavily on one very cyclical industry for their prosperity. That might be tourism, it might be a particular kind of energy, it might be a narrow slice of finance or tech. When that one engine stumbles, everything tied to it feels the impact. Jobs, tax revenue, housing values. If a state has built a lot of its promises on the assumption that this one sector will always be strong, a downturn there can force abrupt changes. I don't like being in situations where My well-being depends on a single point of failure, whether it's a stock, a manager, or a local industry. If I add all that up, chronic budget stress, large unfunded promises, heavy climate and insurance exposure, aging population, concentrated economy, I start to see a pattern. A handful of states check so many of those boxes at once that, to me, they become clear candidates for do not retire here in 2026. It's not that they're guaranteed to collapse. Nothing is guaranteed. It's that the odds are tilted the wrong way for someone who needs stability more than excitement. When the next real stress test comes, these are the places most likely to respond in a way that harms retirees first, because retirees are the ones least able to move and least able to quickly increase their income. So the way I think about it is simple. If I see a state where the growth story has turned into an infrastructure and insurance headache, where long-known pension problems are still unresolved, where young workers are quietly leaving, and where leaders have preferred wishful thinking to early course correction, I don't need to wait for a formal crisis. I just cross it off my list as a place to tie my future to. In the next part of this discussion, I want to walk through the remaining states that end up on that list and show you a few different but equally dangerous ways a state can drift into becoming a bad bet for your retirement. Now, let me walk you through the rest of the places that end up, in my mind, on the do not retire here in 2026 list. A few of them may surprise you because they still have a reputation for being safe or sophisticated or well off. The problem isn't that they're poor today. The problem is the path they are on and who is likely to be asked to absorb the cost of that path if things turn. Some states fall squarely into the overpromiser category. For years, they've offered rich public pensions, generous benefits, and expansive programs without putting commensurate money aside. Budget after budget has acknowledged the gap and then nudged it forward when markets were strong and interest rates were low. That felt almost harmless. Asset prices covered a multitude of sins, but in a world where returns are more modest and debt is more expensive, underfunded promises turn into a constant drain. If I see a state where the unfunded obligations tower over annual revenues and where serious reforms keep being postponed, I assume the taxpayers and homeowners are the backstop. If I were a retiree moving there, it'd have to accept that part of my property tax bill is really a late payment on somebody else's past promise. Others are classic shrinking-based stories. They have proud histories, major cities, strong universities. But if you look closely, you see something worrying. Year after year, more people are leaving than arriving, especially younger working-age residents. Jobs have moved, industries have changed, and the tax base is eroding. The older population that remains rightly expects health care, safe streets, working infrastructure. Those things don't get cheaper as they age. When you combine a smaller base of workers with a larger group of retirees, you're looking at a slow squeeze. In that environment, moving there to enjoy low prices is like buying into a company that looks cheap only because everyone else can see what's coming. There are also places that try to compensate for these weaknesses by leaning harder on one or two volatile revenue sources. Maybe it's tourism, maybe it's a particular commodity, maybe it's capital gains in a very frothy housing or stock market. While the boom lasts, the budget looks healthier than it really is. The danger is what happens when that single pillar cracks. If a recession cuts into travel, or a commodity cycle turns, or a housing correction hits local values, that glossy revenue disappears very quickly. The fixed costs do not. When I see a state that has become dependent on a narrow, cyclical stream of money, I don't want to be there as a retiree the year that stream dries up. Add to that a small group of states caught in the crosshairs of repeated high-cost disasters and high rebuilding expectations. They may not get as many headlines as the most obvious coastal or wildfire zones, but they sit in river basins, fire-prone regions, or storm tracts where once-in-a-century events now seem to show up every decade. Local governments feel pressure to keep rebuilding, to keep people whole, to restore normalcy. Insurance markets quietly get more selective, deductibles rise, exclusions lengthen, premiums climb. Eventually, you see homeowners turning more and more to state-backed or last resort insurance mechanisms. Those mechanisms are, in the end, supported by everybody who lives and pays in that jurisdiction. As a retiree, you're signing up for that tab too. When I pull back and look at all 7 of these states together, what strikes me is not the individual quirks, but the shared profile. In different combinations, they mix heavy, long-term promises, fragile or shrinking tax bases, exposure to expensive physical risks, and leadership that has preferred patchwork to full repair. None of that guarantees a dramatic collapse. What it does is increase the odds that when the next serious test arrives, these are the places where leaders will reach first for the easiest pockets to tap: homeowners, especially those on fixed incomes. So I don't think about this list as a set of villains on a map. I think of it as a pattern. If a state you're considering shares that pattern, too many promises, too little funding, too much concentration, too much physical risk, too little early honesty, it doesn't much matter whether it's number 3 or number 8 on anyone's list. From my perspective, it belongs in the same category, a place where if I had the freedom to choose, I would not tie my retirement. In the next part of our conversation, I want to shift from naming risks to something more constructive, how to think about where you do put down roots, and what I would do if I were in your position, looking out at the next 20 or 30 years and trying to stack the odds in my favor. If I were planning my own retirement in 2026, here's exactly how I'd think about where to live. I would start by admitting that this is no longer just a lifestyle choice. It's a capital allocation decision. You're deciding where your life savings will sit, what rules will surround it, and who will be allowed to change those rules over the next 20 or 30 years. The first thing I'd do is build a very simple checklist for any state. I'm considering, is this place broadly living within its means, or is it chronically spending more than it takes in? Have they made big promises on pensions and health care and actually funded them, or are they mostly booking hope as an asset? Are people and businesses moving in or quietly moving out? What does the insurance market look like? Are premiums stable and coverage available, or are companies raising rates sharply and walking away from certain neighborhoods? Those are not academic questions. They are early warning signs. It'd also pay close attention to the direction of travel on taxes and fees. A state that is modestly taxed but has been steady and predictable for years is more attractive to me than a state that advertises very low taxes today but has an obvious hole in its books. In one case, you can plan. In the other, you are trusting that future politicians will ignore arithmetic to protect your current good deal. That's not a bet I like. If I see a pattern of temporary taxes that never go away, or serial hikes to plug repeating gaps, I assume there will be more of that. On the practical side, I would do everything I could to preserve flexibility. If I were unsure about a place, I'd rent before I buy. Owning a home is wonderful, but it also anchors you. Renting for a year or two gives you time to see how the state and the local government behave when a storm hits, when a budget shortfall appears, when a big employer leaves. You learn quite a lot by watching how a community reacts under stress. If the first instinct is to be honest, share the pain, and fix the problem, that's a good sign. If the instinct is to deny, delay, and dress it up, that tells you something too. It diversifies my exposure as well. That might mean not tying an overwhelming share of my net worth to a single property in a single high-risk region. It might mean keeping some assets in places with different risk profiles, even if I'm living in only one of them. It certainly means keeping enough liquidity so that if I had to move in 10 years because the local situation deteriorated, I could do so without dismantling my entire financial life. None of this requires perfection. Every state has flaws. The goal is not to find a magical place where nothing bad happens. The goal is to find a place where, if bad things do happen, recessions, disasters, policy mistakes, the local system has enough resilience, honesty, and flexibility that you are not treated as the easiest solution to every problem. If you can find that, even if the winters are a little colder or the view a little less dramatic, you've improved your odds in a way that matters far more than the weather. I've spent more than 7 decades watching what happens when people trust stories and ignore numbers. A retirement state can feel safe right up until the moment its old promises, its debts, its demographics, and its exposure to the physical world all collide. And it doesn't fail all at once, but quietly, through higher bills, thinner services, and pressure on anyone living there when the bill comes due. You're not just choosing where to spend your time. You're choosing which government will surround your savings, decide your property taxes, Shape your insurance market after the next disaster and decide whether budgets are hard facts or flexible suggestions. So instead of asking whether your state is on someone's list, look at the pattern. Are young people and businesses moving in or out? Has it faced pension and healthcare problems or just papered them over? Is the insurance market stable or jittery? And do leaders tell hard truths early or soothing stories until there's no room left? In retirement, you don't need perfection. You need margins of safety, financial, physical, and political. So choose a place where the numbers and behavior point in that direction, even if it means compromising a little on the postcard view, because the real luxury is waking up where the rules aren't likely to change just when you're least able to move.